Good afternoon, all. My name's Phil Bryant, and I'm a chartered Acuity partner and head of the financial planning and estate planning specialist advisor team here at Acuity Professional. Welcome to you all, and thank you for joining us for our 2021 spring budget review. This is quite a dry topic, as you can imagine, but we will do our very best to bring this to life for you. Just moving on to our disclaimer slide. Just want to cover a little bit of housekeeping and confirm that we are not providing any advice today. We're very happy to do so, but this will be on a one-to-one basis. And we will make this very easy to access at the end of the webinar, should you wish, and I'm sure that Rosie will cover that off for us. So what are we going to cover today? I think that we can all agree that this has been one of the most anticipated budgets in recent times. Budgets in the past have been very secretive events with very little leaked information prior to the Chancellor standing up. However, this budget leaked a number of different initiatives in the days leading up to it. The 95% mortgage scheme, the extension of the stamp duty holiday, the extension of the furlough scheme, and even the increase in the contactless payment limit. So, what can we make of this as a fiscal and business support package in response to the biggest crisis we've seen in the last 300 years? And as so much of the budget was already drip-fed into the media, what did we actually learn from Wednesday? So in reality, I think what we really learned from the budget was the timing of these measures, and that's clearly become one of the most important factors that we're looking at today. I think it's fair to say that the intention is quite clearly to defer the majority of the taxation increases to a time in the future when the Chancellor believes we will be over the pandemic crisis and well into the recovery period, when these tax increases can likely be more comfortably absorbed. The scale of the numbers involved was understandably quite a shock to many. 407 billion spend on supporting UK workers. The UK's national debt is likely to be an eye-watering 3 trillion by 2026. And the budget has created a scenario where tax as a percentage of national income is going to be at its highest point since the Second World War. But clearly this has been and still continues to be a global event of wartime-like magnitude, and it will clearly leave financial scarring for some years to come. So the purpose of today, as Rosie mentioned, is to look at the high-level impact of how the budget will affect personal finances. I will touch upon the impact of businesses, but my colleagues John and Dan from the corporate finance team will look at this in a far deeper dive next week on the 10th, and I would thoroughly recommend that you join them. So I'd like to pass over to my colleague Chris. He's going to talk about the budget and the impact of the budget on income tax and capital gains tax, pensions and inheritance tax. So over to you, Chris.
Yeah, thanks for that, Phil. So I'm Chris Larby. I'm an advisor in the Acuity financial planning team. Now I've been a financial advisor for coming up to 15 years, and I'm delighted to have the chance to speak to you all today. We kick off from a personal tax perspective. I think a lot of people are anticipating a few more changes than what the Chancellor announced, and certainly changes that would have brought about a more immediate and increased contribution towards a burgeoning national debt that Phil alluded to. In fact, the immediate changes, which I'll come on to shortly in a bit more detail, will actually see a more modest increase in take-home pay next year for everyone, roughly between £22 and £50. However, what's clear is that the freeze on future inflation increases in the bands will see more people move into higher rates of tax through pay rises they might have anticipated experiencing over the next 5 years. So let's talk about the main headlines from Wednesday's budget and do a quick rundown on the income tax bands and allowances. Most of you, I'm sure, will be familiar with the personal allowance. Now, notwithstanding other allowances, this is the tax-free income threshold above which you start to pay basic rate tax at 20%. It's currently £12,500, but set to rise by £70 from April. And thereafter, as we've just mentioned, remaining in place until 2026. The basic rate ceiling will rise from April 2 to £50,270, and then, like the personal allowance, it will remain frozen for 5 years. Income above this level will continue to attract tax at 40% until you reach £150,000 of taxable income when the additional rate kicks in, and anything above this level is taxed at 45%. There is something of a hidden tax trap that you may have heard of before, And this occurs when income starts to exceed £100,000. Well, this is because at this level, you start to lose your personal allowance. And this means not only do you start paying tax on the additional income above that level, of course, you also start to bring more of your income into a position where it's now liable to tax. It works by reducing your personal allowance by £1 for every £2 of income you have above £100,000. So this means that when income is £125,000 or more, the personal allowance will be nil. Now, the reason we call this a tax trap is that the effective rate of tax, or in other words, the rate of tax on every specific pound of income between £100,000 and £125,000 is actually 60%, which I think you'll agree is quite staggering, and something you should be well aware of, if you do find yourself in this position. Now, if your income is around this sort of region, and of course, if you're able to, making adjustments to your income to reduce it below this level may be something you want to consider. If you can't adjust your income, then making personal pension contributions, as an example, may well be something worth looking into, though it's something that you might want to seek advice on as well. It's also worth pointing out there are a few tax allowances that remain unchanged from April and have not been frozen at the end of the tax year. These are, the £2,000 annual dividend allowance. So someone who owns shares in a business can receive up to £2,000 in dividends before they're liable to any income tax. Now, this is in addition to the personal allowance. The personal savings allowance, this is the amount of savings interest you can earn before potentially being liable to tax. This remains at £1,000 basic rate taxpayers and £500 for higher rate taxpayers. Additional rate taxpayers don't actually get this benefit. The starter rate for savings, currently £5,000, also remains unchanged. So with these last few things, the Chancellor has left himself some room to make changes to these allowances from the 2022-23 tax year. So that's a brief overview of income tax and obviously the impact they'll have on the tax we'll pay. So we'll briefly talk about capital gains tax as well before we move on. So capital gains tax, or CGT as is often abbreviated, it's a profit you make when you sell or dispose of something that's increased in value. So it's the gain you make that's taxed, not the amount of money you receive. When it was announced that the annual exempt amount, which is currently £12,300, will be frozen until 2026, I think a lot of people breathed a collective sigh of relief, in part due to the pre-budget fears that significant changes in this area were inevitable. In freezing the exemption for 5 years, these fears have been allayed, for now at least, and there are no major changes to report. It therefore remains the case that if you're a basic rate taxpayer, after calculating your capital gain, you pay tax at 10% or 18% if the gain relates to residential property, though this excludes your home. Higher and additional rate taxpayers both pay 20% on chargeable gains or 28% on gains from residential property. So we'll move on to the pension slide. Now, the popularity of pensions as a savings vehicle has soared in recent years. This is mainly due to the introduction of pension freedoms in April 15. If you recall, these saw the end to compulsory annuitisation. Now, many financial commentators speculated about changes to pension tax relief, specifically the potential for this to be reduced to a flat rate. Unfortunately, this didn't happen, and marginal rate relief still exists, again, for now at least. The government did announce a consultation into investment rules for pension schemes, principally to support the economic recovery. But Rishi's exact words referred to innovative new ventures. This is to ensure that pension schemes are not discouraged from such investments that are able to offer better returns for savers. There isn't a great deal of detail on this, so I'm sure more information will come. The main victim of Wednesday's budget in terms of pensions legislation was the lifetime allowance. Now, this is the capital limit on the value of pension benefits an individual can accrue in their lifetime without incurring additional tax charges. This is currently just over 1.073 million and is set to now remain in place until 2026. And whilst the lifetime allowance may seem like an amount that may only affect the wealthiest, capitalisation of lengthy defined benefit service combined with any other pension savings can easily affect the unsuspecting. The freezing of the allowance will certainly ensure more people are affected as the years move on. Now, briefly mention that for those of you fortunate enough to have a valuable defined benefit pension, we do actually offer a comprehensive defined benefit review service, and we'd be happy to provide more information on this outside of this webinar. No changes were made to the annual allowance. This is the limit on the amount of money that or the amount of pension benefits, more specifically, that someone could accrue each year, and this remains the lesser of £40,000 or 100% of qualifying earnings. Now, qualifying earnings includes most forms of taxable income, so rental income counts, for instance, but it does specifically exclude dividends. An individual can carry forward unused allowance from up to 3 previous tax years. This can be a particularly useful planning feature. A tapering of the annual allowance exists when income exceeds £240,000, and this also remains unchanged. So let's quickly run through the distinct and unique benefits of investing in a pension. Limited companies that contribute into pensions for their employees, and this includes directors, enjoy relief against corporation tax, as contributions are tax deductible. That's providing they pass the wholly and exclusively test. Individuals that pay into pensions receive tax relief at their own marginal rate. Thus, it costs just £55, £60 or £80 for additional rate, higher rate and basic rate taxpayers respectively to contribute £100 of their own money to a pension. Like an ISA, monies grow free from capital gains tax and income tax, but unlike an ISA, the money sits outside of your estate for inheritance tax purposes. And this moves us smoothly onto the next slide to discuss inheritance tax. The Rishi made no changes to the existing inheritance tax regime, though the freezing of the nil rate bands, which I'll come on to in a moment, will provide the Chancellor with some relief as the years progress. The Office for Budget Responsibility has forecast that the freeze on the nil rate bands will result in inheritance tax receipts for the 25-26 tax year of £6.6 billion. So to put this into perspective, receipts for the current tax year are forecast to be just £5.2 billion, which is quite a saving. Again, I'll briefly run through the key components of this tax. So the nil rate band, also referred to as the inheritance tax threshold, is the amount up to which an estate has no inheritance tax to pay. The nil rate band is £325,000, and as previously mentioned, it's going to remain at that level until 2026, together with the residence nil rate band. So the residence nil rate band, which was introduced in 2017, acts as a top up to the main band and works in a similar manner by reducing the value of your estate that is subject to inheritance tax. It applies only where an interest in the family home is left to your direct descendants. So that's children, grandchildren, etc. The residence nil rate band will remain at £175,000 until 2026, as will the residence nil rate band taper, which reduces the residence nil rate band by £1 for every £2 the estate is worth over £2 million. And finally, let's not forget the standard inheritance tax rate, which is substantial, is £40,000. It's remaining at that level. Excuse me, 40%, and it's remaining at that level. So what can you do if you think you might have a problem? So spending your money, and clearly this will remove monies outside of your estate, though be mindful that the value of your estate does include personal possessions. So for instance, buying fine wine or art, as an example, won't really solve your problem. You could utilise gift exemptions. So there are various gift exemptions that everyone can make use of each year. I won't go into too much detail here, but over time, these could be useful measures to reduce your estate, particularly if you're able to start early. Now, gifts that do fall outside of the main exemptions will form part of your estate if you die within 7 years of making the gift. And this will be in full if this happens within 3 years, but tapering down to 0 after 7 years. You can also invest in pensions, as I previously mentioned, and this could be pensions not just for you, but could be other family members as well. You can utilise something called business property relief, or you can take out an insurance policy to ensure the tax liability, though premiums could become expensive over the long term. And finally, one of the most useful things you can do is ensure you have a will. Ensure it is relevant and up to date, and ensure that it makes your intentions clear and specifically makes full use of the nil rate bands. So that's it from me. I hope that's been useful, and I'll hand you back to Phil, who's going to cover some of the key changes that affect businesses as well as the property market.
Thank you, Chris. Yes, that was really helpful. Appreciate you doing that. So let's take a look at business taxation, which I think is slide 7. I think that might be the previous slide there, Rosie. So,
can you see that one, Phil? Are we on? It says business taxation continued.
Yeah, the one before that.
Okay, got it. Sorry about that. There we go.
That's the fella. So let's take a look at business taxation. The Chancellor extended the main employment support schemes to the end of September. And as we all know, the most significant of these was the COVID job retention scheme, the CJRS, the furlough scheme we all are familiar with. That was covering 4.7 million employments at the end of January, with a cumulative cost of nearly 54 billion. According to the Chancellor, the government's total pandemic-related spend during 2021 and 21-22 will amount to £407 billion. And to put that figure into context, it's 14 billion more than the total amount that income tax will produce over the same 2 years. So according to the Office of Budget Responsibility, the OBR, they've pulled together these stats. But as mentioned earlier, John and Dan will be looking at these measures in far more detail on the 10th. But one of the key measures from the budget for businesses and business owners was the change to corporation tax. The main rate of corporation tax will remain at 19% for the year beginning the 1st of April 2022, and it will rise to 25% from April 2023 for businesses with profit of £250,000 and above. So the rate for businesses with profits of 50,000 or less, that's going to remain at 19%, and there is going to be a marginal taper for profits between 50,000 and 250,000. So looking at loss relief, this was an interesting and potentially very beneficial amendment. The period over which businesses may carry back trading losses will be extended temporarily from 1 year to 3 years. And this extension will apply to a maximum £2 million worth of unused trading losses made in each of the tax years 2020, 2021 and 21-22. So the same maximum will apply separately to companies' unused trading losses. The £2 million cap will be subject to a group level limit, requiring groups with companies that have the capacity to carry back losses above 200,000 to apportion the cap between their companies. And it's probably worth noting at this point that your business might be entitled to a valuable R&D, research and development tax credit, even if it doesn't make taxable profit. We'd suggest that you check your position. You might be surprised what expenditure can qualify and how much it could be worth to you. So just moving on to the next slide. The super deduction for investment, this was a real headline grabber. Another very interesting change, and again potentially very beneficial. So companies investing in qualifying new plant and machinery between April 2021 and March 2023 will benefit from new first year capital allowances. Investments in main rate assets, those that currently qualify for 18% writing down allowance, will be relieved by up to 130% super deduction, while investments in assets qualifying for the 6% writing down allowance will benefit from a 50% first year allowance. And this, I believe, really represents the Chancellor's desire for companies to invest their way back to productivity. In terms of VAT, until the 31st of March 2024, the VAT registration threshold will remain as it is now, that's 85,000, and the deregistration threshold will stay at 83,000. And as previously announced, businesses that deferred their VAT payments due between the 20th of March and the 30th of June 2020, they'll be able to pay them in 8 to 11 interest-free equal monthly instalments up to the end of March 2022. And businesses may opt into the scheme until June 2021, and the number of instalments will depend on the date of that opting in. And businesses that do not choose this option must pay that deferred VAT by the 31st of March 2021. The tourism and hospitality, the temporary reduced rate of 5% for hospitality, holiday accommodation and attractions is extended until the 30th of September 2021. Now, I think we could all appreciate these sectors have clearly been significantly suffering as a result of COVID, so this is positive news for those affected. The new reduced rate of 12.5% will apply from the 1st of October 2021 to the end of March 2022, at which point the rate will revert to the 20% standard rate. So if we look at profit extraction, the relative taxation of salary, including national insurance, dividends and pensions, it really plays a key role in determining business owner remuneration strategies. So these changes will obviously have an impact. So if we look at some actual figures, before any dividend can be paid, corporation tax must be paid first. So on a simple comparison of £1,000 of profit, under 19% corporation tax, 810 is available to be paid as a dividend, and this reduces to a maximum of 750 when the new rates commence. Therefore, as there is less post-corporation tax profit to pass on. Dividends from companies with higher rates of corporation tax will see lower income for their business owners. And limited company owners may be particularly affected if they are looking to extract all of their profit in a year, which would normally be a combination of low salary, high dividends. This may need to be amended to a model where in-year profits are taken entirely as salary. So many may be considering if they should switch from a dividend to a salary strategy, given these changes. And given the higher rates of overall taxation, some will see with profit extractions through the dividends route, this makes the redirections, as Chris mentioned earlier, of profits into the pension system much more attractive, with only those dividends needed for immediate needs will be taken out. A really crucial point to note here is that the Chancellor has very kindly given us a window of 2 years to plan and prepare for these changes coming on board. So if we look at the property market, the headlines for this are twofold, really. It's the stamp duty land tax nil rate band of 500k, the holiday being extended until the 30th of June 2021, and then dropping to 250,000 until 30th of September 2021, returning to its standard level of 125,000 on the 1st of October this year. And in addition to that, there was something that again was leaked out prior to the budget happening, new mortgage guarantee schemes to enable all UK home buyers to secure a 95% mortgage on properties up to 600,000. So if we look at this and look at what's happened in the housing market, the housing market has defied logic somewhat in the period of the pandemic, thanks to a raft of unprecedented moves that probably now seem like ancient history to all of us. The Chancellor has attempted to calm fears of a fundamental fall in prices. So let's look at what happens now and how the new normal will look, at least for the short term. So for mortgages, as I said, the Chancellor has announced a new version, and those that will be familiar with the Help to Buy scheme, this is essentially a new version of that. It's incentivising lenders to offer mortgages to people who only have small deposits of 5%. So it's available to anyone buying a first-time home worth up to 600,000, and the Chancellor already has a fairly lengthy list of lenders who will be offering mortgages under this scheme from next month. Some have accused this scheme of inflating house prices, and it comes after the stamp duty holiday was thought to have helped drive prices up by as much as 8.5%, despite the economic crisis caused by the pandemic. If we then look at the stamp duty holiday extension, the stamp duty holiday saw a surge in people buying homes, again, arguably increasing prices. There has been concerns prices might immediately drop when it came to an end. However, it's now been extended as it is until the 30th of June, and then as we've mentioned, after that, the nil rate ban until September. So clearly there's more opportunity for funding in the property market, but beware.
I think Phil's just having an internet issue there. Chris, do you want to just finish off this slide? Oh, there we go. Sorry, Phil, we just lost you for a second there. You're back. Carry on.
No, my apologies. I was just saying, clearly there's opportunity for funding here within the property market, but we just need to be wary of some artificial price changes due to some very volatile demand. And affordability is so crucial. As I say, I work very closely with our mortgage desk and our mortgage advisors and see firsthand the challenges that clients face from mortgage underwriters and valuers, as there is still an embedded fear that when these measures do cease, there will be a potential reduction in property values in the future. So moving on to the next slide, Rosie. I think it's fair to say that the success of the vaccine rollout has allowed the Chancellor to defer these taxation increases. And should we spring back to productivity quicker than expected, there's potentially some scope to roll them back. But at the same time, should we not spring back to productivity as hoped, there is the same potential to increase the taxation measures. CGT, capital gains tax, as Chris mentioned, that was left alone for now, but there is clearly scope to amend in the future should the Chancellor need to. So at a basic level, there's an element of a gamble from the Chancellor that the expensive measures taken by the government to protect the economy will promote a very swift return to productivity. And I'm sure that we all agree that we sincerely hope that gamble pays off. So hopefully you found that useful. Thank you to Chris for joining us and commenting today. That's much appreciated. Myself and my team are here to help you, and we are well placed to navigate these unique times that we now face. So I'll pass back to Rosie and just thank you again for joining us.